Hello, my friend. Welcome to Charley Retail Invest. Let's track the latest trend in US economy and share our recent investment in stock and bond markets. By March 11th, the S&P 500 index has officially entered into correction territory, and it has fallen by more than 10% in 3 weeks. The Nasdaq 100 index has fallen by 13.5% in the meantime, and investors are worried that the stock market is going to crash soon. Of course, we all know that it is Donald Trump and his ever-changing, mind-boggling fiscal policies that lead to all the messes in the stock market. The trade wars are escalating to full scale as Trump just announced that he would impose a 200% tariffs on alcohol from Europe. And Canada and US are still wrestling with each other on tariffs on steel, aluminum, and electricity. The market just couldn't catch a breath, and we won't know how the trade wars will end and for how long this turmoil period will last. As such, investors, both institutional and retail investors, were selling US stocks and stock indexes heavily in 3 to 4 weeks. On the other hand, Trump and his administration had recently toned down the scale of the trade war and tariffs that would take place on April 2nd. The market sees that as a more welcoming message to investors, and the S&P 500 index had rallied back by 5% since March 13th, and some think that the rally would sustain even longer. And unsurprisingly, Trump flip-flopped again on March 26, claiming that there won't be too many exceptions on tariffs, which leads to a decline in the stock market today. So the real question for our retail investors are, how should we position our portfolios in this difficult time? Should we play safe by reducing our exposure to the US stock market, or should we use this as an opportunity to buy the dips and purchase stocks at much cheaper prices compared to their peak prices earlier this year? Well, the change of the stock market and risk asset valuation is largely due to Trump's fiscal policy shift, combined with a global debt refinancing cycle that has already started since the first quarter of 2025. What we have in US since the 2020 COVID pandemic is an economy that is largely supported by the tremendous fiscal spending under the Biden administration, with the government issuing huge amounts of debt to prop up the economy and stimulate the consumer spending from the middle class and the rich people. Large corporations across the country have benefited from the government spending a lot, and their earnings have kept rising from 2022 till now. That also explains why the stock market, especially the S&P 500 and Nasdaq 100 index, have risen by over 40% for the past 2 years. However, the majority of American people have not benefited at all from the bull market, and their lives are at very difficult situations because of the high interest rate environment that has been in the case since the Federal Reserve started hiking interest rate back in March 2022. Due to the high interest rate, small to mid-sized companies cannot raise capital to continue their operations because the interest in borrowing money is just way too high. That resulted in large numbers of layoffs since 2022, and more companies are joining the trend to get rid of employees in order to save cash flow and sustain themselves in this hard economic environment. You might want to ask, but the unemployment rate is still at a historic low of 4.1%, right? Yes, the unemployment rate is calculated and reported by the government, and it underestimates the unemployment situation where people have to take multiple low-paying part-time jobs just to make ends meet. If we just count well-paid full-time jobs as the real employment number, then the unemployment rate would be much higher, close to 20 to 25% level. In the meantime, we have to suffer the the high cost of living due to high inflation, again caused by the tremendous government spending and also the Federal Reserve's QE policies back in 2020 to 2021. So essentially, an average American did not do well at all for the past few years. And that explained why Trump won by a landslide against Harris during the presidential race in 2024. As Trump enters his second term, he has the primary goal to change the US economy from being largely driven by government spending since the pandemic to an economy driven by private sector growth and corporate America, like what we had back in 2019 and before. However, he cannot achieve that goal under the current high interest rate environment because, again, it's just way too expensive for companies to borrow money when the benchmark interest rate is at 4.5% annually and the 10-year Treasury yield is at 4.34%. And that's why Trump's administration has claimed that the main focus of his second term is not the stock market anymore, but the 10-year Treasury yield. We could argue that Trump's tariffs policy and trade wars against Mexico, Canada, Europe, China, and all other major trading partners are just ways to disrupt the global geopolitical landscape, destroy the current US economy, and cause a crash in the stock market. By causing chaos and disasters, Trump could force the Federal Reserve and Jerome Powell to drastically cut interest rate from 4.5% as of today to 3% or even lower in a relatively short period of time. Nonetheless, Trump is playing a very dangerous game as the world leaders will react aggressively to retaliate back and double down in tariffs against all US exports. Overall, it may lead to another global financial crisis like what we saw in 2008, and it might take several years instead of several months to rebuild consumer confidence and boost up business back to normal. To make matters worse, a global debt refinancing cycle has already started in 2025. As we can see, the non-financial debt has been piling up rapidly since the fourth quarter of last year, and global investors are selling US stocks heavily to pay for the upcoming debt. This process will last for a year or so, which means the stock market will likely have more downside pressure throughout 2025. Another key question is, how long will the bottom go for the US stock market? Has the S&P 500 index hit a regional low at around 5,500 points? Or will we see another 10% or even 20% decline from here? Well, if we look at President Ronald Reagan's first term back in the 1980s, we know that he was doing something quite similar to what Trump is attempting to do today, to reduce government spending and have the private sector carry the momentum of the economy. The transition caused a 30% decline of the S&P 500 index from November 1980 to June 1982, before the index rallied strongly from mid-1982 to August 1987. While it is highly unlikely that Trump administration will allow the stock market to continue falling for another year, as the midterm election will happen in fall of 2026, we do believe it's likely that the S&P 500 index may have another 10% downward pressure from where we are today. That means the regional bottom will be around 4,900 to 5,000 points, which is roughly 20% lower compared to its peak back in mid-February of 2025. And the transition period will likely last for 3 to 6 months at least, meaning that the real bottom of the stock market may not be reached until September or October of 2025. Keep in mind that during Trump's first term, the stock index crashed by 20% from the peak in December 2018. This time, the decline would be comparable to that, if not larger. Given the deteriorating financial conditions and unstable fiscal policies, we recommend cutting stock and equity exposure to 25% or less of the entire investment portfolio. Instead, we would allocate the majority of our capital to invest in short-term treasury bonds, such as USFR, SGOV, SHY, and VGSH. It is also advisable to keep at least 60% of the portfolio in short-term bonds, as they are the only safe haven assets in a regime where growth is trending lower and inflation is trending higher. In fact, that's what Warren Buffett and Berkshire Hathaway have been doing for quarters, as their short-term treasury bond positions has surpassed $300 billion in late 2024. Apparently, Buffett is waiting for the stock market to go down further before cashing in to buy the eventual dip of this bear market. Among the stocks or stock indexes, we could look for potential buying opportunities in international markets, such as the defense sector in Europe, which is EUAD as the ETF. We can also think about buying the Europe Zone Stock Index EZU, as well as Australia Index EWA. Within the United States, we could look for defensive sectors such as utility and consumer staples, which are represented by XLU and XLP respectively. Also, high dividend, low volatility ETFs such as SCHD and SPHD are good choices as well. However, we strongly recommend limiting the overall exposure of the stock market to 25% or less, as we are in the early stages of a bear market. Apart from stocks and short-term treasuries, we could allocate 10% of our position in mid to long-term treasuries, which include IEI, AGG, IEF, TLT, and EDV. However, we don't want to put too much capital in buying long-term treasuries just now, because the 10-year yield is still on the rise, and we might see the yield keep rising to above 4.5% before it turns around again. That means long-term treasuries like TLT will have downward risk to drop in prices in the next few weeks. Finally, we can set aside 3% of our portfolio in buying Bitcoin ETFs, such as IBIT and FBTC. There is certainly high volatility for cryptos in 2025, so we want to minimize the risk of a crash in Bitcoin prices in the coming months. However, Bitcoin price will eventually go up after the Federal Reserve starts money printing again in late 2025, so we need to keep an eye on that. And that's the whole story of today's video. If you are a retail investor like myself and would like to know more about the US economy and our most recent trading activities, please consider subscribing our channel, Charley Retail Invest. Thank you so much for your time and support. I'll see you in the next video. Please take care in this ever-changing world.